Hello and welcome to Any Answers Answered for January 2023. Happy New Year to all. Hopefully your tax returns are going okay so far. Two questions, as ever, that Tim and I have picked from the pages of Any Answers to have a look at. Our first question, Tim, this month is from Spuddle. And Spuddle is asking a question about furnished holiday lets and business assets disposal relief. The question is about mixed use, Tim. Client acquired a domestic property in 2012. Property was used for family visit purposes till July 15, when it was left under qualifying FHL rules. The FHL ceased in November 2019 and the property has been recently sold. The question that we're looking at here is on the basis that it was owned and let as furnished holiday letting for at least 2 years, ending on the date of cessation, and it's been sold within 3 years of that. Does the whole capital gain qualify for business asset disposal relief without apportionment? Question mark. Tim, over to you.
Yes, is my understanding correct, says S. Puddle. Yes, it is, although there is a caveat, and quite interesting to look at the commentary that follows this. It's a very interesting, and one would have thought, a not unusual scenario, and yet over a month now has passed since this was put up on AccountingWEB, and at the time we're recording this, there are only 2 comments, and in fact, there are only really 1 comment, and that comes from Richard Thomas, who is always worth reading and gives usually a very good analysis of the legislation that applies in a particular situation. And Richard draws our attention in his answer to S. Puddle to section 169 I and L of the Taxation of Chargeable Gains Act, Capital Gains Act 1992, I think it was. So if a letting qualifies as a furnished holiday letting, then because of the deemed trading status, yes, business asset disposal relief, now what used to be entrepreneurs relief, is indeed available, provided that the necessary conditions are met. And where we're looking at a business, here it's a property letting business owned personally, the necessary condition is essentially that the business has been qualifying for at least the 2 years, 24 months, up to the date of cessation. And then if we're looking at particular business assets, you do have 3 years within the date of cessation within which you can sell those assets and qualify for business asset disposal relief. Now, that means, other things being equal, that S. Puddle is absolutely right, and that or Richard Thomas is absolutely right, and that the gain on the furnished holiday let, despite the fact that for most of the period of ownership, it wasn't an FHL, it was used for family purposes, it will qualify for the relief. However, there is, as Richard Thomas puts it, one cloud on the horizon. There's an exclusion from business asset disposal relief for investments. So an asset that is an investment is not going to count as a qualifying business asset under section 169L4B, and HMRC might want to argue that the asset being sold, which will be the rental property, that asset actually has been held as an investment, and certainly for business property relief purposes for IHT, we've had cases, of course, that would confirm that let properties, even furnished holiday let properties, do count as investments rather than as non-investment assets. But with that caveat in mind, the basic answer is that yes, it will qualify unless HMRC want to argue that it is in fact an investment.
And we should always take the opportunity, Tim, when it is presented to us, to remind people of this distinction between investment for IHT and non-trading for capital gains tax. And it is a fundamental difference, well, it's a 30% difference, but it is fundamental to the 2 areas of tax.
Yeah, what you're getting at, Giles, wouldn't be relevant in this particular scenario, where we're looking at companies and whether shares qualify or not for business asset disposal relief. we've got to make sure that the company is wholly trading apart from insubstantial non-trading activities. And the definition of wholly trading is not set out in terms of what does or doesn't count as insubstantial. Revenue guidance on it has always been 20% is the threshold above which non-trading activities would compromise the relief. So that's the 20% you refer to, although the recent Allen case gives the lie to that, and that comes up in our other answer. But the point for business property relief for IHT, you're quite right, there it's a 50-50 threshold, not 20-80, and that's because you will qualify for business property relief as long as the business is not wholly or mainly making or holding investments. And that wholly or mainly has always been interpreted, as far as I know, as a 50-50 threshold. So as usual, tax far more complicated than any of us would like, but that needs to be factored in as well.
And as you say, that leads us perfectly into the second question, which comes from Andy DC, a question about business asset disposal relief, excess cash. And the question, very simply put, is excess cash in a business an issue when claiming business assets disposal relief? Situation Andy seems to have: limited company with around £1.5 million in cash, company's trading company providing digital marketing services, and the cash has been accumulated over the past decade from profits, husband and wife owners, no investments or properties. And the question is, does the cash present a problem in terms of business asset disposal relief?
Again, the question has to look at the interpretation of the legislation, which restricts business asset disposal relief to companies that are wholly trading apart from insubstantial non-trading activities. And this is where that definition, if we focus forensically on it, is indeed very different from that wholly or mainly holding or making investments barrier for inheritance tax. And let's focus on the word activity. The first thing that we have to ask is whether this trading company that provides digital marketing services, so it's generating its profits from that, whether the holding of £1.5 million in cash counts as an activity. And as long as that cash is not actively managed, so as long as the company is not putting the cash on the money market, switching it from overnight to 7-day deposit to squeeze an extra 0.25% or whatever out of it, then we would argue that it's not an activity. And if it's not an activity, then we don't need to consider whether it is substantial or not, because, I repeat, the barrier to business asset disposal relief is where the trading company has substantial non-trading activities. So we focus on that word activity. On this question, there were a dozen or more comments in answer to the question, and a reference, in fact, to that Allen case, which involved a company that had investment properties. And there was no question that it was not an activity. So in that case, we were looking at an activity. The tribunal decided that HMRC's standard approach of applying a 20% threshold was not in fact engrossed in the legislation anywhere and was not to be taken as carved in tablets of stone. In other words, that 20-80 split, which I mentioned earlier, isn't necessarily always going to be the case. But what was key in the surplus cash point was whether it was an activity at all. And if it's not an activity at all, we don't need to count it. So it doesn't matter whether it's 20-80 or 25-75 or anything like that.
And it's an area of tax, well, I suppose it's two areas of tax, where we can't just look at that 50% test. We can't just look at that 20% test. We need to think about how they interact in such a large range of ways, and something that has to be considered every time there is a business disposal. Hopefully useful, and also hopefully you will have a good rest of January working through those tax returns. We look forward to seeing you on the other side, but for today, bye-bye.